How many days do you think separate a peaceful inauguration from a banking crisis? 48 hours. That's all it took in 1933. A new president took the oath of office on a Saturday, and by Monday morning, every bank in America had locked its doors, while the entire financial system froze in less time than it takes most people to recover from a weekend. Here's what should make you uncomfortable. We're watching the exact same sequence unfold right now. A president was inaugurated on January 20th, 2025. The debt ceiling had already been breached 19 days earlier on January 2nd. Treasury began using emergency accounting tricks on January 21st, and somewhere between June and September of 2025, those tricks run out. After that, the United States government cannot pay its bills. This isn't speculation, but the official projection from the Congressional Budget Office, the Treasury Department, and every major financial institution tracking this situation. The math is public, the timeline is known, but almost nobody is connecting what happened 92 years ago to what's happening right now. Because the pattern isn't about presidents, but about the moment when political power changes hands while the financial system is already cracking. This video is about one idea. When debt reaches critical mass, the transfer of political power doesn't stabilize the system but triggers the crisis. You've been taught that inaugurations represent fresh starts, new directions, renewed confidence, but history shows something different. When an empire is drowning in debt it cannot repay, when the currency is stretched beyond its limits, when the bills exceed the revenue by trillions, the handoff of power doesn't fix the problem but exposes it because the new administration inherits a system that's been barely held together by the previous one. And the moment those emergency supports shift, the structure collapses. 1933 proved this, while 2025 is proving it again. And the only question is whether we'll recognize the pattern before we hit the same outcome. I'm the debt archivist, and my job is to dig through old files to find the patterns your news never explains. Today we're opening the file on presidential transitions during debt crises, March 1933 and January 2025. This isn't about politics, since Democrats and Republicans have both presided over this exact sequence, but about what happens when the math stops working and the calendar forces a decision. Because in both cases, in 1933 and 2025, the incoming president inherited a debt bomb with a timer already running, and in both cases the timer reached zero within weeks of taking office. Let's start with the case that rewrote the rules. Franklin Delano Roosevelt and the banking crisis of 1933. FDR stood on the steps of the Capitol to take the oath of office on March 4th, 1933, while the country was in year 4 of the Great Depression. 1/4 of the workforce had no job, families were losing homes, bread lines stretched for blocks. But the most immediate crisis wasn't unemployment, but the banks. Banks had been failing in waves for 3 years where, when customers panicked and rushed to withdraw their savings, banks couldn't pay because they'd lent the money out, invested it in stocks that had crashed, or lost it to bad loans. Bank runs became contagious, where one failure triggered fear, which triggered more withdrawals at other banks, which caused more failures. The banking system was in a death spiral by early 1933, and states began declaring bank holidays, temporary closures to stop the bleeding. Michigan went first in February, then Maryland, then Ohio, and one by one governors shut down their state banking systems, hoping to prevent total collapse. President Herbert Hoover, still in office until March 4th, refused to declare a national bank holiday because he believed the problem would resolve itself, believed intervention would make it worse, believed confidence would return if the government just stayed out of the way. So he did nothing. 38 states had closed their banks by Inauguration Day while the New York Stock Exchange was barely functioning. People were hoarding cash and gold, and the financial system of the United States was hours from complete shutdown. And this is where the transition of power became the trigger. FDR took office at noon on Saturday, March 4th, and by midnight Sunday, March 5th, his cabinet and Treasury officials were drafting emergency orders. At 1 a.m. on Monday, March 6th, just 36 hours after taking the oath, Roosevelt issued Presidential Proclamation 2039, where every bank in America was ordered to close immediately. All banking transactions were suspended, and the entire system went dark. This was unprecedented, since no president had ever shut down the nation's banks, but Roosevelt understood something Hoover had refused to accept. The system was already dead, and pretending it was alive only made the panic worse. By declaring the bank holiday by forcing a pause, Roosevelt gave himself time to separate the solvent banks from the failures. Congress passed the Emergency Banking Act on March 9th, 5 days after inauguration, giving the federal government authority to inspect banks, recapitalize the healthy ones, and liquidate the hopeless ones. Roosevelt went on radio on March 12th for his first fireside chat, explaining in plain language what had happened and why people could trust the banks that would reopen. Banks began opening again on March 13th, where people deposited more money than they withdrew, and within weeks, confidence returned, while within months, the immediate banking crisis was over. This became the blueprint for crisis management. When the system is breaking, act decisively, explain clearly, and restore trust through transparency. But here's what the history books skip. Roosevelt didn't cause the crisis, but inherited it. Hoover's administration had accumulated the debt, made the policy mistakes, and refused to act. But the calendar meant Roosevelt owned the crisis the moment he took the oath, and the trigger wasn't the economy, but the transition itself. Because when power changes hands during a financial emergency, the brief window when nobody is fully in charge, when the old administration is packing up and the new one is unpacking, that's when the system breaks. Markets hate uncertainty, creditors hate transitions, and when you're already on the edge, that moment of handoff is when you fall. Now let's compare. Roosevelt in March 1933 versus the current administration in January 2025. Both inherited a debt crisis that was already in motion, both faced a ticking clock, both took office while emergency measures were the only thing preventing immediate disaster. Roosevelt walked into a banking system where 38 states had already shut down, while the current administration walked into a situation where the statutory debt limit had been breached on January 2nd, 18 days before inauguration. Treasury Secretary Janet Yellen notified Congress that extraordinary measures, the accounting maneuvers that let the government keep functioning, would begin on January 21st, 1 day after the new president took office. Roosevelt had about 48 hours before he had to act, while the current administration has somewhere between 150 and 240 days before extraordinary measures run out. The numbers are different, but the sequence is identical. The problem was bank runs in 1933, where depositors wanted their money faster than banks could liquidate assets, while in 2025, the problem is debt service, where the government needs to borrow $2 trillion this year to pay its existing bills, but legally cannot borrow past the ceiling that was hit on January 2nd. Roosevelt's solution was a forced pause, a bank holiday that stopped all transactions until the system could stabilize, while the current solution is a managed delay, using extraordinary measures like suspending investments in federal employee retirement funds to create temporary borrowing room. But here's where the comparison gets uncomfortable. Roosevelt's bank holiday lasted 1 week, where the banks that reopened were inspected, recapitalized, and backed by new federal deposit insurance, and the crisis was resolved in weeks. The current debt ceiling crisis has no resolution in sight, where Congress must raise or suspend the limit before extraordinary measures exhaust, or the United States will default on its obligations for the first time in history. The crisis forced immediate action in 1933, but in 2025, the crisis is being delayed, pushed down the road, extended through accounting tricks until some future date when Congress might act. The psychology is different too, where Roosevelt came into office with a mandate to act boldly, and his inaugural address promised swift, decisive government intervention. The current administration came into office with a divided Congress where one party controls the House, another controls the Senate, and neither has the votes to raise the debt limit without negotiation. Roosevelt faced a crisis everyone could see, since banks were closed and people couldn't access their money, making the emergency obvious. The current administration faces a crisis that's invisible to most Americans, where the debt ceiling sounds abstract, extraordinary measures sound like boring accounting, and most people don't realize the government is operating on borrowed time. But the pattern is the same, since in both cases the transfer of power didn't stabilize the system but activated the next stage of the crisis. If you strip away the details, the pattern looks like this. Stage 1 is cheap money and easy debt, where the system encourages borrowing, interest rates are low, deficits don't matter, and everyone believes the party will continue forever. In the 1920s, this was stock market speculation on margin, while in the 2010s and 2020s, this was government spending financed by printing money and near-zero interest rates. Stage 2 is everyone calling it sustainable, where economists reassure the public, politicians promise there's no problem, central bankers insist they have tools to manage any situation, and the consensus is that this time is different, that the rules have changed, that modern systems are too sophisticated to fail. In 1929, this was the belief that the stock market had reached a permanently high plateau, while in 2025, this is the belief that reserve currency status makes U.S. debt risk-free. Stage 3 brings first cracks where a bank fails, a margin call happens, a debt auction goes poorly, and these are small signals, easy to dismiss as isolated incidents, but they're warnings that the system is losing its ability to absorb shocks. In 1930, this was the early bank failures in agricultural states, while in 2024 and 2025, this is rising bond yields, increasing interest costs, and foreign central banks reducing their treasury holdings. Stage 4 is authorities doubling down where instead of admitting the problem, officials insist everything is fine and use emergency tools that were meant for short-term crises, extending, pretending, and delaying. President Hoover refused to declare a bank holiday because he thought it would panic the markets, while Treasury in 2025 is using extraordinary measures to avoid hitting the debt ceiling because Congress can't agree on a long-term solution. Stage 5 is confidence breaking, which is the moment when the gap between official reassurance and observable reality becomes too wide and people stop believing. In March 1933, this was when New York and Illinois governors finally shut down their state banks at 2:30 in the morning, admitting the system had failed. While in 2025, this will be the moment when markets realize extraordinary measures are about to expire and Congress still hasn't acted. Stage 6 is forced reset, where the system cannot continue in its current form and something breaks. Banks close, currencies devalue, debt restructures. In March 1933, this was the National Bank holiday, and the question for 2025 is what form the reset takes. Whether Congress raises the debt ceiling, whether Treasury prioritizes payments, whether the Federal Reserve intervenes, or whether the United States misses a payment and triggers a technical default. The pattern is consistent across every debt crisis in history, where you can see it in Rome when they debased the denarius, in Spain when the silver mines ran out, in Britain when they abandoned the gold standard, and in every empire that borrowed beyond its ability to repay. The stages don't change while only the speed varies, and right now, we're somewhere between Stage 4 and Stage 5. Let's talk about the people who manage these crises and why they think the way they do. Politicians operate on election cycles where a congressman faces voters every 2 years, a senator every 6 years, a president every 4 years, and their incentive is to avoid pain during their term and pass problems to the next administration. Raising the debt ceiling is politically toxic since it requires voting to increase borrowing, which sounds irresponsible even though the borrowing pays for spending that's already been approved, so politicians delay, negotiate, attach conditions, kick the can down the road, and hope someone else deals with it later. This happened in 2011 when Republicans demanded spending cuts in exchange for raising the debt ceiling, happened in 2013, happened in 2023, and it's happening again in 2025. The script is predictable, where both parties blame each other, both claim they're protecting the country, both refuse to move until the deadline is imminent, and every time the resolution comes at the last possible moment, just before default. Central bankers think differently since the Federal Reserve's job is to maintain financial stability, and when a crisis hits, the Fed's instinct is to provide liquidity, to make sure markets keep functioning. This is what they did after Black Monday in 1987, after the 2008 financial crisis, and during the COVID pandemic in 2020. But the Fed cannot raise the debt ceiling, since that's Congress's job, which means the Fed's options are limited. If extraordinary measures run out and Congress hasn't acted, the Fed might buy treasuries to keep the bond market stable, might lend to banks that face liquidity crunches, might do whatever it takes to prevent a meltdown, but they cannot solve the underlying problem, which is that the government is spending more than it collects and has reached the legal limit on borrowing. The public, meanwhile, normalizes dysfunction, where most Americans assume Congress will eventually raise the debt ceiling because they always do, and the crises in 2011, 2013, and 2023 all ended with last-minute deals. So why would this time be different? This is exactly the mindset that prevailed before every major collapse, where in 1929 people assumed the stock market would keep rising because it always had. In 2007, people assumed housing prices would keep rising because they always had. And in every case, the majority believed the pattern would continue right up until it didn't. And this is the psychological trap. The more times you avoid disaster, the more confident you become that disaster is avoidable until the time it isn't. Let's connect this to right now. The statutory debt limit was reinstated at $36.1 trillion on January 2, 2025, the exact amount of outstanding federal debt on that date. Immediately, a scheduled redemption of Medicare Trust Fund securities lowered debt by $54 billion, giving Treasury temporary room to borrow. And on January 21st, one day after the inauguration, Treasury began using extraordinary measures. These measures include suspending investments in federal employee retirement funds, halting certain government securities issuances, and manipulating cash balances, and together they provide roughly $336 billion in additional borrowing capacity. Combined with Treasury's existing cash balance, that's enough to finance government operations until somewhere between June and September 2025. The Congressional Budget Office projects the X date, the day when Treasury can no longer pay all obligations, will arrive in August or September, while some analysts think it could come as early as June if tax revenues disappoint, and others think it might stretch into October if receipts are strong. But the range doesn't matter as much as the certainty, since at some point, between now and early fall, extraordinary measures will be exhausted, and at that point, if Congress has not raised or suspended the debt ceiling, the United States government will not have enough money to pay everything it owes. Treasury would face an impossible choice: pay bondholders and skip Social Security, or pay the military and default on interest. There is no legal mechanism to prioritize payments where the systems literally cannot do it, since Treasury makes hundreds of millions of payments each month. And the computers aren't programmed to pick and choose. This is the scenario that keeps central bankers awake at night, not because they don't understand the politics, but because the markets don't care about politics. If the United States misses a single payment, even by accident, even for technical reasons, even for one day, the perception of risk-free Treasury debt evaporates. What happens then? Bond yields spike, borrowing costs explode, the stock market crashes, the dollar weakens, consumer confidence collapses, businesses stop investing, and the feedback loop accelerates. Higher interest rates make the debt more expensive to service. More expensive debt requires more borrowing pushes closer to the ceiling, and the cycle feeds itself. This isn't hypothetical, since in 2011, when Congress delayed raising the debt ceiling, Standard & Poor's downgraded the United States credit rating for the first time in history. Interest rates on government debt rose, and the Government Accountability Office estimated the delay cost taxpayers $1.3 billion in fiscal year 2011 alone, and $18.9 billion over the following decade, purely from higher borrowing costs. Congress acted before default in 2011, acted at the absolute last minute in 2023, and in 2025. With a divided government and entrenched positions on both sides, the risk of miscalculation is higher than it's ever been. And this is happening at the exact moment when U.S. debt is at its highest level since World War II, where federal debt held by the public is 99% of GDP. Total federal debt is 123% of GDP. And interest payments on that debt are approaching $1 trillion per year, more than the defense budget, more than Medicare. The United States is spending roughly $1.9 trillion more per year than it collects in revenue, and that deficit must be financed by borrowing. But borrowing is capped by the debt ceiling, and the debt ceiling cannot be raised without Congress. This is the trap. The math requires borrowing, the law prohibits borrowing, and the politics prevent changing the law. So what does understanding this pattern give you? First, it frees you from the illusion that any currency, including the dollar, is untouchable. For most of your life, you've been taught that U.S. Treasuries are the safest asset in the world, that the dollar is backed by the full faith and credit of the United States government, that American debt is risk-free. And those statements were true when the debt was manageable, when deficits were temporary, when the political system could make hard choices. They're less true today. Second, it gives you context for the news you'll see over the next 6 months, where when headlines scream about debt ceiling negotiations, when politicians make dramatic statements about fiscal responsibility, when markets swing on rumors of a deal, you'll understand what's actually happening. This isn't new, but stage 4 of the pattern. Authorities doubling down, pretending the problem can be managed indefinitely. Third, it helps you recognize the moment when confidence breaks, since you should watch the bond market. If yields on long-term treasuries start spiking, if foreign central banks accelerate their sales of U.S. debt, if credit default swaps on U.S. government bonds start pricing in real default risk, those are signals that we're moving from stage 4 to stage 5, and most people won't notice until it's too late, but you will. Fourth, it clarifies your own decisions where you don't control government debt, don't control Congress, don't control the Federal Reserve, but you control whether you treat the dollar as something permanent or as something that can change. You control whether you diversify, whether you hold assets that aren't denominated in dollars, whether you prepare for a world where U.S. debt isn't automatically risk-free. And fifth, it shows you that the sequence is already in motion, since this isn't a warning about something that might happen, but documentation of something that's happening right now. The debt ceiling was breached on January 2nd. Extraordinary measures began on January 21st. The ex-date is between June and September, and the calendar is set while the only question is whether Congress acts before then. If they do, the crisis gets delayed again where the ceiling gets raised or suspended. Borrowing continues, and we move closer to the point where even raising the ceiling isn't enough, where the interest on the debt becomes so large that it crowds out everything else, where the math stops working entirely. If they don't, we find out what happens when the reserve currency issuer defaults, and based on every historical example of debt crises, it won't be pretty. The archive doesn't predict the future, but shows you the sequence we're already in. Stage 1 was cheap money and easy debt, and we did that for 2 decades. Stage 2 was everyone calling it sustainable, and we're past that. Stage 3 was first cracks appearing with bond yields rising and foreign demand declining, and we're here. Stage 4 is authorities doubling down with extraordinary measures, delays, and last-minute deals, and we're doing this right now. Stage 5 is confidence breaking, and we're approaching this. The pattern doesn't care whether you believe in it, doesn't care whether Congress is Republican or Democrat, doesn't care whether the president is popular or unpopular. The pattern cares about math, and the math says that when an empire borrows more than it can repay, when it hits the legal limit on borrowing, when it transfers power during the crisis, something breaks. 92 years ago, it was the banks, and today it might be the bond market or the dollar or the credit rating or the political system itself. If you want more calm, no. Nonsense breakdowns of how debt, empires, and currencies really behave. Subscribe to the Debt Archive because the files are open, the pattern is clear, and the next stage is coming whether we're ready or not.